Imagine waking up to a future where your money works for you, where instead of the sound of loose coins in your pocket, you hear satisfying notifications of dividends being deposited into your account. Picture a world where financial freedom isn't just an idea, but a reality. And the best part, this isn't an unreachable dream. A comfortable retirement means different things to different people. Some sell what they own, others move somewhere cheaper, but there's one option most people overlook: living off dividend income. Earning $3,000 per month is possible. And in this video, you'll learn 3 fast ways to achieve it. So, where should you start? The answer is simple: your lifestyle and your numbers. The average person might spend around $68,000 a year, but that doesn't have to be your target. You can shape that number based on your own needs. Now, think about this: your investments are generating income for you continuously, allowing you to earn without touching your principal. Think of it like a tree that keeps producing fruit over and over again. That's exactly what passive income is. And with the right strategy, this life is closer than you think. In this video, you'll see step by step how to earn $36,000 a year or $3,000 a month. But first, let's start with a basic concept. What is a dividend? When you own shares of a company, you own a part of that business. When the company makes a profit, it can either reinvest it for growth or distribute it to shareholders. That distributed portion of profit is called a dividend. You earn income based on the number of shares you own. This payment can be in cash or it can be reinvested. Most companies pay dividends quarterly, and this is where an important concept comes in: dividend yield. This shows how much your investment is earning and is one of the most important indicators when evaluating a stock. This rate can vary from company to company and even change over time for the same company. Generally, more established companies tend to offer higher dividend yields compared to smaller, newer ones. So, how is dividend yield calculated? It's actually quite simple. You take the annual dividend per share and divide it by the stock price. For example, if a stock is worth $100 and pays $10 annually in dividends, the dividend yield is 10%. Understanding dividend yield is crucial when evaluating investments. It helps you compare different stocks and make smarter decisions based on your goals and risk tolerance. By investing in dividend-paying stocks, you can generate regular income without selling your shares. This means you can preserve your investment while still creating a steady cash flow. That's why dividends are such an attractive strategy for those seeking passive income. Over time, they can help you grow your wealth and even live off the income generated by your investments. Now, let's look at one of the effective ways to generate income through dividends. Strategy 1: Covered call ETFs. One of the fastest ways to generate income with dividends is by investing in covered call ETFs. These funds allow you to earn income from both stock appreciation and dividend payments. So, how do they work? These ETFs hold stocks in their portfolio, and at the same time, they generate additional income by writing call options on those stocks. Call options give the buyer the right, but not the obligation, to purchase shares at a specific price within a certain time frame. When the ETF sells these options, it collects premium income, which is then distributed to investors as dividends. If the stock price exceeds the option's strike price, the ETF can sell the shares and also generate capital gains. Examples of such ETFs include XYLD, OILK, and EWZ. These funds typically offer double-digit returns, which are considered quite high. Looking at the past 12 months, XYLD has returned 11.83%, OILK 11.82%, and EWZ 11.81%. The biggest advantage of these ETFs is that they provide a more stable cash flow by generating income from both dividends and option premiums. However, there is something important to keep in mind. Like any investment, this strategy also carries risks. Options can expire worthless, or stock prices may decline, which can negatively affect overall returns. That's why understanding the risks before investing is always critical. Now, let's think about this strategy with real numbers. If your goal is to earn $2,900 per month or roughly $35,000 per year, through covered call ETFs, you need to build your investment plan accordingly. Based on current yield rates, reaching this goal may require a capital investment of approximately $280,000 to $310,000. Sounds quite attractive, right? Because with traditional dividend stocks, achieving the same level of income could require an investment of around $2 million. But with covered call ETFs, earning $35,000 annually or $2,900 monthly becomes possible with significantly lower capital. This strategy not only reduces the initial capital required, but also offers the opportunity to create a steady cash flow. For those who want to pursue this path, covered call ETFs can be a powerful option for living off dividends and achieving financial independence. Now, let's move on to another method for reaching the same income goal. Strategy 2: high yield REITs, real estate investment trusts. REITs are companies that invest in real estate, such as shopping centers, offices, and residential properties. They generate income from rental payments and distribute a portion of that income to investors as dividends. For those looking to generate passive income through dividends, there are some very attractive options. And for example, Two Harbors Investment Corporation offers a dividend yield of around 20.3%. Brandywine Realty Trust offers about 19.9%, and Orchid Island Capital provides approximately 19.4%. These types of REITs have historically shown strong performance when it comes to providing regular income to investors. In fact, historical data shows that the REITs have delivered an average annual return of around 10.8% over the past 20 years. This tells us that investing in REITs can be an effective way to both grow wealth and generate consistent income. However, there is an important detail to consider. REIT income is not fixed. Occupancy rates of properties and overall economic conditions directly affect these returns. In other words, while they may offer higher income potential than regular stocks, they can become riskier during economic downturns. So, what does it take to earn $35,000 per year with REITs? If you target an average return of 10.8%, an investment of around $320,000 may be sufficient. Of course, this amount can vary depending on whether you invest in a single REIT or diversify across multiple REITs. One of the most effective ways to achieve financial freedom with REITs is quite simple: invest consistently and allow your dividends to grow over time. With a disciplined and patient approach, it may be possible to reach financial independence within approximately 5 to 7 years. When investing in dividends, one of the most important things is having a clear plan. You need to know exactly how much income you need and what your target is. This clarity helps you choose the right REITs for your portfolio and stay committed to your plan over time. Remember, everyone's life and needs are different. It's possible to live comfortably with less than $35,000 per year, or depending on your lifestyle and responsibilities, you may need more. One of the biggest advantages of REITs is that, unlike regular stocks, they typically pay dividends on a monthly basis. This makes them especially attractive for those who want to generate consistent and frequent cash flow from the stock market. With the right REIT strategy, it is possible to earn $35,000 per year or around $2,900 per month in dividend income. This approach can turn the dream of living off dividends into reality. For those looking to take a step toward financial independence, exploring the world of REITs is truly a smart move. And yes, when applied correctly, this strategy has the potential to turn dreams into reality. Now let's move on to the third strategy. Strategy 3: dividend aristocrats. Dividend aristocrats are a special group of companies within the S&P 500 index. What makes these companies stand out is that they have consistently increased their dividends for at least 25 consecutive years. This makes them a strong option for investors who want reliable and consistent income from their investments. For example, 3M, Leggett and Platt, and Walgreens Boots Alliance are among the most well-known companies in this group. On average, these companies offer a dividend yield of around 7%. Yes, this is lower compared to covered call ETFs or REIT, but in return, they provide much more stable income. The key characteristic of dividend aristocrats is that they increase their dividends every year. In fact, to be included in this group, a company must have raised its dividend for at least 25 consecutive years. Of course, whether these stocks are suitable for you depends entirely on your goals, your investment horizon, and your risk tolerance. Although these companies operate in different sectors, they share common traits: a long established history, consistent growth, and strong financial structures. They are typically large scale companies and tend to perform more resiliently even during difficult periods. This allows them to generate steady profits and continue paying dividends. So, how much investment is needed to reach a monthly income target of $2,900? Assuming a dividend yield of around 7%, you would need an investment of approximately $500,000 to achieve this goal. At first glance, this may seem high, but compared to the roughly $2 million required to generate the same income from traditional dividend stocks, it is far more attainable. To reduce risk, it is much healthier to spread your investment across multiple dividend aristocrats rather than putting everything into a single company. This way, you can build a more balanced portfolio and increase your potential to generate steady income. The strong dividend history of these stocks, along with their inclusion in the S&P 500, further increases their reliability. Remember, financial freedom is not built overnight. It is built with the right strategy and patience. Now, the next step is up to you.